Welcome back to another session of financial forensics. Today what we will deal with the next financial statement. So far what did we do? We worked on, basically if I have to say that, we worked on what is called as balance sheet. Then we worked on what is called as income statement. Balance sheet, as I indicated in the earlier session, it gives you what is owned by the firm or the entity and what is owed by the entity, and income statement gives you what is called as what are the revenues that have accrued during that particular period and what are the expenditures that have accrued during that particular period out. Now I move to the third financial statement. The third financial statement is what we call it as cash flow statement. Now, how different is cash flow statement? Why do we need cash flow statement? Is income and expenditure statement not sufficient enough? There will be all kinds of questions in your mind. Please note, your income statement or income and expenditure statement or profit and loss statement or revenue and expenditure statement, by whatever name you call it, records all the revenues that you have earned and all the expenditure that you have incurred, or all the expenditure that have accrued, or all the revenue that has accrued to you, irrespective of whether you have received the cash or not received the cash. If I go back and sort of look at it, even when I said that today being the 12th of, for example, January out here, if I make a sale on a 30-day credit as of today, and then I have sold the goods, ownership has transferred, money is going to come to me only in February, whatever days, after 30 days out there, and today I drop the profit and loss statement or the income statement for the period 1st January to 12th January, I will include that amount of sale that I have made today on credit as part of the sale, and that is what we call it as accrual concept. Why? Because it is part of the sale, purely because your ownership is transferred as of today. The ownership part of it is basically transferred as of today. So what has happened? The sale has accrued as of today. The sale has accrued as of today. So your income statement, when I talk about your income statement out there, my income statement will look at those aspects, that is the ownership transfer aspects or the benefits that you have enjoyed. For example, as per the act, if you hire a laborer, you can pay wages up to the 7th of the following month out. Supposing I have hired laborers, they've started work on the 1st of January. On 31st of January, I am liable to pay them wages, but I have the time to pay them till 7th of February. So on 31st of January, if I draw up an income statement for the month of January, the salary has accrued as an expenditure. The salary will be paid only on 7th of February, but it has accrued as an expenditure. That is, it will be shown as an expenditure in the P&L statement or the income statement of the month of January. Cash outflow is not. Why? Because I've enjoyed the benefits of those fellows working for me. The people whom I have hired to work, they have worked for me and I have enjoyed the benefits of their work. So the wages that I have to pay has accrued. So an expenditure has accrued. I am liable to pay. So that is what we call it as the accrual concept, as I said, and that is what will get recorded in the income statement. Income statement will record revenues when ownership transfer occurs. Expenditure, again, what do you call it as when you have enjoyed the benefits of a particular, when you enjoyed the benefits out there, that particular amount has accrued as an expenditure in this particular case. Now what do we look at? Now, so what happens? That is the reason I had indicated that when we say profit profit is not equal to cash. Profit is not equal to cash out there. Profit is basically not equal to cash. Why profit is not equal to cash? Because as I said, I have sold goods today on a 30-day credit. I have got some money. I have added it in the revenue. My profit will be calculated based on the goods that I have sold today also, though I have not received cash. So profit is not equal to cash. But for any business to survive, we need to know. We need to know. What is it that we need to know? You need to have cash for your operations out there. You need cash for all your activities. You need cash for all your activities. So what do? We prepare what is called as cash flow statement. Now cash flow statement. What does a cash flow statement tell you? Cash flow statement, if I have to make it very simple, forget about accrual concept. Cash flow statement is on and actuals. That is, it records cash inflow, it records cash outflow. That's all. All the cash coming in, yes, it will find a place in that cash flow statement. All the cash going out of the business, yes, it will find a place in the financial statement. Now I say, I have basically imagined that you sell goods on 30th of March on credit, 30-day credit. Now you prepare a profit and loss statement for the financial year April to March. Let us say I have sold goods on 30th of March 2022. 30th of March 2022 on a 30-day credit. Now I prepare a profit and loss statement for the financial year 21-22, that is April 1st, 21, 1st of April 2021 to 31st of March 2022. Please note, financial year in India, when we say, it is always from 1st of April to 31st of March in the following year. I repeat, when we say financial year, we always mean that it is from the 1st of April to 31st of March in the following year. That is what we call it as a financial year in India. It varies from country to country. If you look at our neighbor country Bangladesh, it is from July to June. If you look at a western country like the US, it is equal to the calendar year Jan to December. So financial year varies. Let us look at in India, it is April to March. Now given the fact that in India it's April to March, the financial year is from April to March. Imagine on 30th of March, I have sold goods on credit. 30th of March 2022, I have sold goods on credit for whatever amount out there. Now I drop a profit and loss statement or an income statement for the financial year 21-22, that is 1st April 21 to 30th of March 22. When I drop the profit and loss statement for the financial year, profit and loss or income statement for the financial year, the sale that has taken place on 30th of March on credit is also included in the revenue. Whereas, when I prepare a cash flow statement for the year 21-22, for the same financial year 21-22, there is no cash inflow from that sale, so it will not find any place there at all. Whereas, for 22-23, that is 1st April 2022 to 31st of March 2023, if I prepare a cash flow statement and if I have received cash in the month of April on the sale that I made on 30th of March 2022, it will find a place in the cash inflow in the financial year 22-23. I repeat, it will find a place in the cash inflow in the financial year 22-23. So, cash flow statement records money coming into the business, money getting out of the business. That is all. Actually, it does not worry about which year it pertains to, etc. Supposing I receive money on a sale that I have made 5 years earlier, 5 years back, I receive the cash today. If I prepare a cash flow statement for the financial year 22-23, it will find a place in cash inflow, money received on a sale that took place 5 years back. I don't worry, but money has come in today, it will find a place in the cash flow statement as of today. So, cash flow statement is worried only about actuals, money coming in, money going out. Now, when we say cash flow statement, we always mean cash and cash equivalents. We always mean cash and cash equivalents. What do you mean by cash equivalents? Cash equivalents are very simple. Anything that can be converted to cash very easily. For example, I said that I will say, imagine I have what is called as hard cash in my cash box. Cash in my cash box. Agreed. Money, let me erase this and write it properly. Oh God, I didn't erase it. I'm going to write it. Money in the company's account in the bank. Money in the company's account in the bank. Then what happens? We also look at what do you call it as next one, marketable securities. Now, what is this marketable security? We call it as liquid assets. I mean, not liquid asset, liquid financial asset per se. That is, these, instead of keeping it in the form of cash, I am keeping it in the form of a security which I can easily convert to cash. I can just take it to the market and then sell it and recover the cash and come back. That is where we call it as marketable securities. Those things that can be converted to cash in a jiffy. So, when we say cash and equivalents, we mean all these: cash in the cash box, money in the company's account, marketable securities, any other asset which can be easily converted to cash in a jiffy. So, all that we consider as cash and cash equivalents. Now, having said that, when I drop my cash flow statement, I basically have three categories. The first one, we say cash flow from operations. Next, we have cash flow from financials, from financing. Next, we have cash flow from what is called as investing activities. Now, why are we classifying all this? Why do we need to classify all this? Imagine a company, you open your cash box, it has a lot of money. So, do you have to feel happy about it? Yes and no. Why? I feel happy about it if all that cash has been generated because of my operating activity and without significantly increasing my liability. I will be unhappy if all the cash has been generated purely from financing. Imagine I can just go out and borrow money. If I just go out and borrow money, money can keep coming in and my cash loss can be bloated out there, can be very high. But that does not make me happy, because I have borrowed. When I have borrowed, what is happening? I have to repay the money. Not only repay, I have to, what is called, there is a cost of that money also. That is, I have to pay interest on the borrowing. That is what we call it as the cost of the funds out there. So, what do? We classify the cash flows both inflow and outflow, money coming in and money going out, into these three categories: operations, financing and investment. By investing, what do we mean? I create any asset, use the cash. For example, I use the cash to buy a machinery. I use the cash to buy what is called as a car for my company. I use the cash for whatever it is. Then what is happening? I am investing this money in creating an asset out there. So what is happening? Because that asset is going to be there performing and going to give me a return for whatever, time immemorial and so on and so forth. So what is happening? So what happens? That is, when we are spending money to buy a machinery, I am actually investing money in a particular activity. So there is a cash outflow because of an investing activity. The same machinery after 5 years has become scrap, and then I sell the machinery, and when I sell the machinery I get money. What is happening? The investing, the asset on which I have invested, I have disposed of that asset and I have generated cash. So what is happening? Cash inflow occurring because of an investing activity. So when we look at investing activity, wherever money getting out, wherever money coming in. For example, I can say one more example. I go out and then invest money in what is called as another company's assets out there. I invest money in the equity share capital of another company. Cash outflow because of investing. I have invested in the equity share capital of another company. That company issues a dividend. Now when I get the dividend, what is happening? I am getting the money, cash inflow, agreed. Because of why? Why? Because I had invested money in the equity shares of that company, I am getting the dividend. So cash inflow because of an investing activity that has basically happened. Now that I have used the word dividend, let me go back and explain what is a dividend out. I don't think I have explained what is a dividend out there earlier. Now what is a dividend? Again we will come back to it out there. I talked about equity share in the last class. Now the profits are distributed to the equity shareholders, as you know. When profits are distributed to the equity shareholder, the profit that is given to the equity shareholder is what is called as dividend. The profit, the portion of the profit or the entire profit, whatever you might call it, that is given to the equity shareholders is what we call it as dividends out there. So that dividends means it can be full complete profit, it can be part of the profit. For example, yesterday I was reading in the newspaper that TCS had declared a dividend of 75 rupees per share out there. I think 75, if I am not, I think you'll have to check the number. So what is happening? Out of the profits what TCS is making, it is going to give each shareholder 75 rupees. Out of the profits what TCS has made, it is going to give 75 rupees to each of the shareholder, not the entire. The remaining profit, what happens? It will get reinvested. That we will worry about it later. So they are giving that money, and that is what we call it as dividends. Now having said that, now how does the reinvestment work, what happens and so on, we will come to all that. Now in the same, for that, to explain that, let me go back to this, what do you call it, as loan paying cafe case. I said in this, in the profit and loss statement I made, or the income statement I drew up yesterday, imagine I made a loss of 10,854. Hypothetically, imagine that you had made a profit of $15,000. Hypothetically, imagine that you had made a profit of $15,000. If you made a profit of $15,000, what will happen? This $15,000 belongs to whom? Belongs to the three partners out here, the equity shareholders out there. Now, what can I do? I can say out of this $15,000, I am going to, it is not net loss in that particular case, it will become net profit in this particular case. Out there, it will become net profit out here. Now, what happens? This $15,000 belongs to whom? Belongs to the equity holders. I decide to give dividends to them. What is the dividend? I decide to give them a dividend of 12,000 rupees totally, that is 3,000, 4,000 rupees each of the part to each of the partner. Now when I decide to give dividends out there, I will give dividends from where? From the profit. What is the profit? Profit is 15,000. What is the dividend I am giving? 12,000 is the dividend I am giving. Then what is the money left out of the profit? The money that is left out of the profit is only 3,000, and that is what we will talk about as retained earnings. We call it as retained earnings. So what is retained earnings? That means this $3,000 also, sorry, this $3,000 also belongs to whom? Belongs to the shareholders. Why? This entire $15,000 out here, this entire $15,000 out here belongs to whom? Belongs to the shareholders out there. Sorry. This $15,000 belongs to the, I think something is happening. This $15,000 belongs to whom? Belongs to the shareholder out there. Entire $15,000. Out of that, what have I done? $12,000 I have distributed. That means the remaining $3,000 is not yet distributed. The shareholders' money is with me. So what will happen in the closing balance sheet? What is the money that is with me? And that is what we call it as retained earnings out there. The money that is there with me is $3,000 will be, and their capital, which was 48,000 earlier, now I have added $3,000 because the money belongs to them, and now their total capital is about $51,000. Now their total capital is about $51,000. So what has happened? Retained earnings, the earnings which is retained by the company. So what happens when I said TCS is giving $75 to a share? Whatever is the profit that I've made, minus the dividends, rest of it is the money, part of it is my money being a shareholder, but that the company is retaining. Is it legally right? Yes, they can retain out there. Now, should every company declare dividend? Well, no, need not. For example, the companies can say, I am going to retain all the profit that I have made and reinvesting, because there is a lot of opportunities to invest. I am going to retain. That is a decision made by the board, and well, they may not declare dividend. That is perfectly all right. So if for example, in the earlier case I said it is 15,000 as the profit, if they had not declared any dividend, then what will happen? The retained earnings will be the entire $15,000 out there. So what happens? The capital, which was 48,000, has now become 63,000 in that particular case out there. So that is what will happen. That is what we talk about when we talk about dividends. Now, having said that, let me come back here. Let me come back here out there. You have understood what is dividends. Now I move on and discuss all this. So normally, why do I differentiate between these three categories of cash flows? I need to differentiate because I need to know what is the cash that is getting out and coming in from my core activity, operating activity. What is the money that is coming in from what is called as investing activity or going out because of an investing activity. Financing activity, how much am I borrowing or what is the equity I am raising, I need to know. So we look at cash flow from these three activities. The second aspect, once the company reaches a steady state, you are not augmenting any, what do you call it as, capacity or anything. What is happening? The financing cash flows will obviously be negative out there. Why? Because you are not taking new borrowings, you are repaying all the old borrowings, and you are also servicing the borrowings. That is, servicing means paying the interest on the borrowings out there and the earlier borrowings, and you are also slowly repaying the old borrowings. So there is no fresh borrowing that is coming in, normally will be negative. My investing cash flows can be positive, of course. But what happens? My operating cash flows should be a large positive. this large positive, because the money that I am generating from the operations should be sufficient enough for to take care of any investments I am making. Excess money, I am parking it in a debt instrument, I am parking it in a mutual fund, whatever it is, short term instrument. So, investing as well as this positive cash flows should take care of all the outflows because of a financing activity. So, for a company which is in a steady state, for a company which is in the growth path, obviously your what you call it, the financing cash flows will also be positive there, because you need to keep borrowing, you need to keep increasing your capacity. Increasing the capacity cannot happen only from the cash flows from operations. You need to borrow more, you need to raise more capital, you need to put up one more facility, and so on and so forth. So, for a company which has reached a steady state, when I say steady state, the company I am talking about, when it is reached a steady state, I mean to say the companies which where huge amount of capacity expansion is not happening, I am growing with the growth in the market, and so on and so forth, you will have a significant positive in operation, which should be able to take care of cash outflows because of financing, and any cash inflow or outflow because of what is called as investing activity. There can be outflow also because of investing activity. I can invest in other shares, I can get dividends, so on and so forth. So, this should take care of it. That is the reason we basically classify the cash flows into three basic categories. I am going to do a couple of things now. I will take up we will prepare a cash flow statement for the Lone Pine Cafe itself. Now, we have prepared a opening balance sheet, we have prepared a closing balance sheet, we have prepared an income statement. Now, we will prepare a cash flow statement for Lone Pine Cafe itself. Though it is not there in A or B part of it, you can add to that, prepare a cash flow statement for Lone Pine Cafe based on A and B. That's all. Prepare a cash flow statement for Lone Pine Cafe based on the case, let's A and B out. I can do that. But before we, and then followed by that, in the next session, I will also be handling what do you call it as two exercise problems on cash flow, one or two exercise problems on cash flow. Again, it is only from the same textbook which I prepared, chapter 11 in the textbook, and we will be, I will upload the problems that I will be doing on the, I will ask the office to upload the problems also, so that you have access for it, and we will also try and see if we can solve the problems out there in the during the sessions out there. Now, to start with, before I embark on solving that problem of cash flow out there of Lone Pine Cafe, you need to understand two things. Cash flow statement, because you are what do you call it as your friends who are exposed to, who have been exposed to accounting in their undergraduate or their school or whatever it is, would say, oh, cash flow statement can be prepared in two methods. One, we prepare what is called as a direct method, another is called what is called as, what we call it as an indirect method. Now, what is this direct method, indirect method? Isn't it confusing? Yes, it is not confusing. Simple. Let us say direct method. Let me first explain what is a direct method, and then I will come to the indirect method. Direct method is, you have a record of whatever cash coming in, cash going out directly, and you record it. For example, I receive money from from the sale that I made last year. I received today, I will immediately record it. I go out and buy a machinery and pay cash, 20% of it I have paid in cash, I will record it. I will repay the loan which I have borrowed 5 years back, today I will record it, my cash outflow because of a loan repayment. So, what happens? As and when the transactions are happening, when you are recording those transactions, especially related only to cash, so that accumulation of that, or what do you call it as consolidation of all that, is what we call it as a direct method. Moment the transaction happens, immediately you come back and record the transaction out there. That is what you are doing a direct method. Directly I know this is the money I have spent, I am recording. Then what is the difference? What is the indirect method? Indirect method is you can derive the cash flow statement using balance sheet and P&L statement. How is it possible? We can't derive. Now let's get back. Let's take an example. I am going to take one or two examples and then we'll come back to it. My P&L statement has wages 50,000 and this is for the period 1st April to 31st March. Let us say 21 to 22. Now I draw up a balance sheet on 31st March 2022. Liability plus equity, assets. Straight. Now what happens? Wages of 50,000 is there as an expenditure in the P&L statement. I don't see anything in the asset and liability and everything. So wages is an expenditure that is accrued. So it is there. So what is that? What is it? It's a cash outflow that is occurred. Sir, you said that it is accrual concept, it is not cash outflow. Wait. I have written wages 50,000 that is accrued. What if it has not been paid? Well, if it has not been paid, as of 31st of March 2022, what will it be? It will be a liability. So it will also appear in the liability side of the balance sheet. What did I say earlier? It is not liability side of the balance sheet is beautiful, clean, white. That means what? I have obviously paid, that it is not accrued. No, it can pertain to the previous year. It cannot, because what is recorded in the P&L? Only such expenditure which pertains to the period. That is where I wrote the period. If you want, I will write the period a little more legibly in this particular case out there. I will write it more legibly. I will say revenue and expenditure. I am sorry. I will write it a little more legibly in this particular case out there. Revenue and expenditure, or P&L statement and revenue and expenditure for the period 1st April 2021 to 31st of March 2022. So only expenditures pertaining to the period will be recorded in the P&L. If it has not been paid, it will appear in the liability side of the balance sheet. Supposing the balance sheet says on 31st of March 2022 says outstanding wages 20,000. Outstanding wages 20,000. That means what has happened? $30,000, 30,000 rupees has been paid. So cash outflow is 30,000 rupees. You would still argue, sir, this 20,000 has been due for the last 5 years. Has been due for the last 5 years. So what do? I will say, I will look at the balance sheet as of 31st of March 2021 also, and I see this outstanding wages in the 2021, what do you call it as, balance sheet is 15,000 rupees. 15,000 rupees is the outstanding wages as of 2021 March. 20,000 is the outstanding wages as of 31st of March 2022. And P&L, the wages pertaining to the year 1st of April to 31st of March 2022 is 50,000. What is the cash outflow? What is the cash outflow? Very simple. What was, I will do the calculations here. What was outstanding as of 2021? 15,000. What is the wages for the year 21-22? P and L says 50,000. How much is the wages totally payable? That is what is called as the wages that is totally due or totally payable is 65,000 out there. Totally payable or total due is 65,000. How much is still outstanding as of 2022? Still outstanding as of 2022 is 20,000. That means how much have you paid? I'm sorry, 45. I made a mistake. Okay. How much have you paid? I have paid $45,000. That is what I have paid. That means what is the cash outflow? Am I right? Now what is the cash outflow? Cash outflow for the year 21-22. 21-22 is 45,000 rupees out there. So that is how, what am I saying? We are deriving. I am going to take one more example out here. I am going to take one more example. The P and L statement says, I hope I'm communicating, making it very clear out there. My P and L says revenue from sale 1 lakh. Very simple numbers out there. I don't see anything receivable in the asset side. If I have not received this 1 lakh cash, the revenue has accrued as per P and L 1 lakh. No doubt, the revenue has accrued as per P and L 1 lakh. If I have received this 1 lakh, there will be no receivable in the asset side of the balance sheet as of 31st of March 2022. I repeat, if I have received this 1 lakh, there will be no receivable as of 31st of March 2022. If I have not received it, then it will find whatever amount I have to receive as of 31st of March 2022 will be there in the balance sheet. Supposing let us say that in this particular case debtors, in this particular case as of 31st of March 2022, debtors is about 50,000. Perfect. That means what? 1 lakh you have sold, 50,000 you have to receive. That means, and in the year 2021, the debtors column is 0. Assume for the time being in the year 2021, the debtors is 0. That means what is happening? 21-22 P&L, my revenue is 1 lakh. Out of that still I have to receive 50,000, that is debtors. Debtors means the people who have to pay you money for the purchases they have made from you. That means what is the cash inflow? Cash inflow is only 50,000. I will add a small twist to this. I will say debtors in 2021, as of the 2021 balance sheet, is about let us say is about almost 1,10,000. Take an obnoxious figure here, big figure. Debtors as of 2021 was 1,20,000, 1,10,000. Sales for the year is 1 lakh. Current year debtors is only 50,000. That means how much is the cash that you have received? Now let us go by this. Debtors 2021 is how much? 1,10,000. What is the sales for the year 21-22? 1 lakh. That means totally how much you are eligible to receive? 2,10,000 I am eligible to receive. That is what I would say is I am going to use this. I am eligible to get, I will just use a simple word, eligible to get 2,10,000. But still there is 2022, there is a debtor of how much? 50,000. That means how much have you received? I have received 1,60,000. That is received 1,60,000. Though your sales is only 1 lakh, your cash inflow is 1,60,000. That is, there is a cash inflow from operations is about 1,60,000. Your sales for the year is only 1 lakh, but your cash inflow from operation is 1,60,000 because that is the cash that you have received. And this method of using the two balance sheets and the income statement is what we call it as an indirect method. This is what we do in an indirect method. Normally, in any of the annual reports you look at for companies, the cash flow statement is always an indirect method. It is always derived from the cash flow and from the balance sheet and the income statement. Now, all these three statements you see are related. From these two statements, I can derive the cash flow statement, and all will have to match, all will have to be in sync. If it is not in sync, then there is scope for, then what happens? Your job starts as a financial forensic expert. I have given you three statements: the balance sheet, the income statement or the P&L, and then the cash flow statement. Now, if there is any problem with any of these, now if there is what is called as if there is any problem with any of these statements, that is all these three statements, you can see how they sync together. If they are not syncing together, then what is happening? You are, what do you call it as? You have the forensic job to do. Now, how will it sync together? I'm not done it further. I'm going to take one more step out here. Now, what happened? When I paid $40,000, my cash here is coming down. When I got 1,60,000, my cash here is increasing. That is as of 2022. So, what happens? When you start your cash flow statement, I start with the opening cash. Opening cash means I start with the cash balance as of 31st of March 2021. Whatever is the cash balance. I add this, I reduce this. Imagine I had, let us even imagine this. Imagine there is a cash of only about 50,000 as of 31st of March 2021. Now, let us say the cash is only about 50,000 out here as of 31st of March 2021. I have, what do you call it as, I have paid $45,000 cash out there. I have received what is called as $1,60,000 of cash out there. So, what should be my cash balance? Imagine these are the only two transactions. Imagine these are the only two transactions. So, what is that? That is this is what is called as what will be my cash balance as of 31st of March 2022 should be 1,65,000. My cash balance should be equal to 1,65,000. Why? I started with 50,000 on April 1st, 2021. I paid 45,000 for my wages. I received 1,60,000. So, what should be the balance? This should be the balance as of 2022, 31st of March 2022, and that's what it is. So, that is what I am trying to say. That entire thing, all the three statements will basically sync together. If there is a problem, job opens up for you as forensic experts out there. This is a very simple base case. We are talking about a base case out there. I hope I have communicated.